Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He says the stock markets were flat, but some individual stocks did very well. He takes a look at gold, crude, the U.S. and Canadian dollars. Uranium was also a bright spot. Inside Track Trading CEO Eric Hadik examines where we are with some of the cycles concerning the stock markets, gold, silver, Bitcoin, the U.S. dollar, and interest rates. Founder of the Trendletter.com, Martin Straith, digs into the U.S.-UK trade agreement, trade wars, tariffs, currencies, Bitcoin, and decentralized finance. He also has a special offer for our listeners. Author of the second edition of the book, When the Bubble Burst Surviving the Canadian Real Estate Crash, Hilliard MacBeth, runs down the latest on the Canadian real estate market. He says Toronto has been hit hard with reduced prices, and he feels if Alberta keeps making separatist noises, it will see a real estate crash like Quebec did when it nearly voted to leave Canada. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HoweStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HoweStreet.com weekly recap on our homepage at HoweStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Good to be with you, Jim.
Ross, how would you describe what happened on the stock markets this week?
The stock markets were just basically flat, but the stocks weren't. I mean, if you take a look around, we're in the middle of earnings session right now, and some of the stocks are just really kicking off on the upside. Others are getting hurt. But overall, it's a consolidation phase. If you're looking at either the Dow, the S&P, or the NASDAQ, they all, from that massive break into April, they've all retraced about 60 to 70% of those losses, and are just digesting them at this point. The weight of the evidence still, to me, points that we should be back down and retesting the support in that April low at some point in the next few weeks. Opposite side of the coin, though, is that if we take a look at global M2, that's money supply, it continues to just barrel along at new all-time highs. And, when you have that kind of money being created out of thin air, it's looking for homes, and the equity markets historically have been one of the places it goes. The other place that it goes is over into Bitcoin, and Bitcoin has been just racing away at this point. Had an important low in April with everything else, and been doing just exceptionally now over 100,000. So overall, as I say, with the M2 numbers looking positive, we'd need to see the market show some signs of weakness here, maybe as we get towards the latter part of the earnings season, and see a correction at that point.
What's going on with gold?
Gold, we got the upside target here 2 weeks ago, and ended up with, we just kissed 3,400 and then back down pretty hard for a few days. This week, we went back and retested the highs, and that's not all unusual. Most of the tops, when you see the dollar index get hammered the way it did into April, there were two good sell-offs in the dollar this year. The second one, down into that April low, produced what we call an extreme capitulation reading. And historically, when we get that in the dollar index, you get a top in the gold market. And then gold will historically then do a double top, which is now what we're seeing. The first support was back at the 20-day moving average, and we've consolidated from there. The next move, you'd expect to see it test the 50-day average. Right now, that's around 31.70. So I think gold can spend its time digesting the big gain that it had, and within the corrective phase there, 3170 would be a pretty reasonable target in the near term. If that doesn't hold, then what we would want to see is the 200-day moving average, which is well down from here, and produce a better support as we move through the next couple of weeks. On the other side of the coin, the dollar index has recovered quite nicely. This went from 110 down to 98, big break on the index. We're now back at par 0.24, and that's the best week that it has had here since the bottom. Has got some buoyancy. I don't know how far the dollar index will go, but at this point, it was a good-looking low, and I think that support level should hold for now.
What's happening with crude?
Well, with crude oil, a week ago would have said not much. We had a couple of bad days on the downside, and on Monday OPEC came along and said, geez, we're going to increase production here. Well, the model that we have looks for short-term signals as well as intermediate ones, and we got a capitulation reading on Monday, and haven't had one of those in 3 or 4 years in crude oil market. And so that was when we were down hard, got down to 56 on the announcement of the news. We got the capitulation reading there, and we've rallied back to 61 at this point. It'd be hard to say how much farther this has got to go. I think there's some pretty good overhead resistance now.
What's going on with the U.S. and Canadian dollars?
Well, U.S. dollars, I say, capitulation low in April, good recovery now. The other side of the coin, we had 2 weeks ago put out a report saying that the Canadian dollar looked as though it was ready to roll over. It put in a marginally higher high, up around 72.50. Then this week, we got an outside reversal to the downside. That was a higher high on the week with a lower low, with a poor close. So it looks as though the correction on the Canadian dollar is now starting. And ideally, we're looking at somewhere around 71 down to 70 as a support area that you should be looking for.
And anything we should be keeping a close eye on right now?
Well, the hot item has been uranium, which, the uranium price itself has gone from 64 up to 70 in the last month. Pretty good rally there. But the stocks, you take a look at like a Cameco or Denison or the Sprott Uranium Junior ETF, they're up anywhere between 33 and 45% in this last 2 to 3 weeks after hitting some really good signals on the bottom. Those ones getting a little ahead of themselves right now, but clearly it looks as though the bottom is in place for uranium, and you should just be looking at any reasonable pullbacks. If they give back maybe a third of the gains off the lows, they would definitely be worth putting into a long-term portfolio. My view is that uranium is really one of the key products as we move forward here as far as energy is concerned. So take a look at those. Those are some of the big names to look at, and there's, I think, lots of potential there.
Ross, thank you so much for the update.
Always nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Oh, well, thanks for having me back, Jim. Pleasure to be here.
Eric, before we get going, can you tell us a bit about Inside Track, spelled with 2 I's, INSIIDE, and how our listeners can subscribe?
Well, I will answer that in reverse. They can subscribe. They can find out a lot of related information, view a lot of archived reports and sample publications on our website at www.insidetracktrading.com. And as you mentioned, the inside is with two I's, so it's INSIIDE, tracktrading.com. And we provide advisory services in the financial and commodity markets for both short to intermediate traders and longer-term traders. It is technically and cyclically based, although we will certainly address prevailing fundamentals, but the core of the publication is dealing with technical analysis, and not just from an information and analysis standpoint, but also from an educational and tutorial. I try to reapply a different indicator each week and show how it's setting up in real time, and just kind of taking that approach of not just giving a fish, but teaching a trader to fish.
Also, your research focuses in on cycles. What got you into that?
That was kind of a long process, but I would have to say being introduced to the works of W.D. Gann about 45 years ago was what really ultimately led down the cycle path.
Which markets are you focused on with the 17-year cycle?
The 17-year cycle is one of the primary longer-term cycles that I discuss a lot. And really, there are a lot of markets that are impacted by that and that have shown and proven a very consistent 17-year cyclicality. But some of the primary ones of late have been the U.S. dollar, which throughout 2024 and leading into the early part of this year, I kept showing and explaining how the 17-year cycle, as well as a lot of corroborating cycles and indicators, were all telling me to look for an intra-year peak in January of 2025 and then see the dollar plunge through a good part of the year. Come back to that in a few minutes. But the stock market is really the primary market that I discuss the 17-year cycle with. But as I said, it applies to a lot of different markets, and it's got different nuances in different ones, but it still remains a very consistent cycle, and one that should only be ignored at a trader's own peril.
The Dow's been moving higher over the past month. When do you expect the next low in the 17-year cycle for the Dow?
Well, it's not as much expecting a specific low. In fact, the Dow and many stocks and most indexes fulfilled the primary and what I would call the minimum downside expectation for that 17-year cycle. And I suppose it would be a good time to give a very quick synopsis or review of what we've discussed for many years and what I continue to analyze in my publications. But the 17-year cycle is a very natural cycle, but the thing about it is it really has an impact on electromagnetivity, geomagnetivity, and the swings in magnetivity, which directly and indirectly impact swings in psychology, in mass psychology, which ultimately is what you are attempting to measure with technical analysis. But that 17-year cycle has been proven to apply to the Earth and its magnetic swings. In the last 5 to 10 years, they started publishing some papers how the sun has an additional governing cycle that wasn't recognized before, and lo and behold, it's a 17-year cycle. And in the midst of that, there has also been work published over the last 20 years how the interplay between the sun and the Earth's magnetic fields also oscillate on a 17-year basis. So as far as the crux or the origin of that 17-year cycle, that's part of it. But it has been a cycle that has timed consistent peaks in the stock market, and not just any ordinary peak, but peaks that preceded at least 20% to 25% drops, and more frequently 30 to 50% declines. And so coming into late 2024, my Inside Track newsletter and weekly relay advisory service kept focusing on late November as the time when a very powerful convergence of many cycles, ranging from multi-year cycles like this one down to multi-month, multi-week, and even as the time drew closer at hand, daily cycles were all corroborating it and pinpointing November 22nd or the 25th as being the most likely, most synergistic cycle day for a major peak in several of the, what I viewed as the more leading indexes, the S&P Mid-Cap 400, the Russell 2000, the Dow Transportation Average, and even the Dow Industrials were right in there. And my work was showing, and what was published back then was that we should peak in late November and then see a 3 to 6 month plunge that would be at least 20 to 25%. And in many stocks and perhaps some indexes, you'd see something on that 30 to 50% level. And so we saw that peak take hold right on November 25th. Then you started to trace out a topping phase with subsequent highs in late January. And then when the S&P 500 and the NASDAQ 100 finally fulfilled their remaining upside targets in just past mid-February, right around February 19th, that was when it was time for your sharpest decline to unfold. I often correlate it to an old wooden roller coaster where you've got multiple cars in that train, and each one passes the summit at a different time, but it's not until the last car hits the summit and starts to turn down that all the cars can start plummeting in tandem. And so that February 19th peak in the NASDAQ 100 and what it did at that point fulfilled that final summiting index and ushered in a very precarious, very vulnerable 1 to 2 month period. In my late February publications, the Inside Track newsletter, I reiterated that we should see 20 to 25% minimum declines, and that those declines were likely to culminate by early April. So you had both the time and the price magnitude now honing this future potential bottom, but a plunging sell-off in between. And as we went into the month of March, and some additional sell signals were triggered, and daily cycles started to pinpoint a 3-day period in April 3rd through the 7th, 3 trading days. That would be the ideal time for the culmination of a blow-off decline. So all of that was linked to this 17-year cycle. All of it was published weeks, months in advance. And the market saw that plunge, and most of the indexes, most of the stocks bottomed on April 7th in perfect lockstep with those daily, weekly, monthly, and multi-year cycles. And so that fulfilled at least the primary objective for this 17-year cycle, you saw all of the indexes see at least 20 to 25% declines. The Dow Transports plunged 30%. And a lot of your key stocks, in fact, most of your Magnificent Seven stocks saw anywhere from 32 up to 56% drops from late 2024 or even early 2025 into that cycle low in early April. You had some of your high-flying chip AI stocks give even greater declines from their 2024 peaks. A couple of them 60+% declines. You saw high-flying, or at least they were high-flying airline stocks, see almost as bad of plunges in that time. So all of that was a very powerful and very accurate fulfillment of this 17-year cycle analysis. And that's also when many corroborating technical indicators come into play, both on the downside, first the sell signal, then timing downside price targets, but then also confirming a bottom. And in some of those indexes and some of those stocks, it showed that was a very sharp correction, for lack of a better term. And that there's a couple of those indexes that could even head back to their all-time highs. But we might see, based on a lot of other coinciding cycles and technicals, we might see another phase of that type of selling all within this 17-year cycle later in this year and stretching into 2026.
Gold's been moving higher this past month, followed by a pullback, and is now moving higher again. What do you see for gold? New highs ahead?
Well, I think there will be, but I don't think it's going to be right away. Gold fulfilled a lot of the, it had a very consistent annual cycle, a lot of monthly and weekly cycles that were telling me to see basically two surges in 2025. The first one would be in the first half of the year and probably peak between late April and early May, which is what we have seen so far. And the second surge should take hold later in the year. And currently it looks like November is the ideal time for a more significant peak in gold. But as you mentioned, we've seen an initial sell-off in gold, which turned some multi-week trend indicators negative in my work. So this rebound, which just reached 34.50 in the June gold futures, is likely to be a B-wave peak that will not yet exceed the late April high near 3,500. And then if that's accurate, we should see a C-wave decline that sees gold drop from 34.50 down to at least 31.50, and there's a couple other targets that could come into play depending on the action and the close at the end of this week. I'm really focused on that May 9th daily and weekly close as being an important barometer of what to expect from gold in the coming weeks.
Silver's been moving higher since bottoming in early April. Are we likely to see new highs ahead for silver?
Well, I would give you the same answer for that yes, I definitely think there are new highs ahead for silver, but the timing is not quite yet. One of the things I have talked about is that we could be entering one of those phases where the white metals, not just silver, but platinum and palladium, start to take a little bit more of a lead role, and gold starts to settle down a bit and take a little bit more of a secondary role in the next advance. And one of the things that silver did in early April that was so important, I've got this weekly trend indicator that I discuss, well, pretty much every publication, I'm discussing it in one respect or another, but it helps tell me when a market has set multi-month highs, multi-month lows, when a certain sell-off is the whole of a correction, and when it is just the first leg of a downside correction. And there's a lot of other features to it. It's a very valuable tool and really has kept me on the right side of the market many times. But when we had our late October peak in gold and silver, and then you had the sell-off into November, gold reached some critical downside targets. In fact, it precisely matched its one comparative prior decline. Both of them ended up being $260 per ounce corrections. And it maintained a more positive weekly trend structure and other indicators that I use. And that was telling me that gold was likely setting the bottom of its correction at that time. Shortly after, silver saw another sell-off and turned its weekly trend down. That told me that silver's decline from late October into the latter part of December was only the first phase of a broader corrective period. And as it started to rally in January and gold started to rally, gold was projecting rallies to new highs, whereas silver was saying it should go back up and set a lower high, primarily due to this weekly trend indicator. And as we saw that first quarter rally, the one thing I kept reminding my readers of was that the weekly trend was still saying that silver needed a second sell-off, and the whole time it was showing that it should go down to its early August low, which was right around 2760 in the May contract. So throughout that entire rally, as gold was taking off to new highs, silver kept showing that it needed to see another drop, a C wave decline, because that entire rally from late December into late March was viewed as a B wave of an ABC correction. And that in the ideal scenario, silver would drop to 2760 and then set a major bottom. Well, what do you know? In about a week's time, silver went from 35.50 after failing to exceed its October high, which is what was expected. It was not supposed to exceed that high. Went from 35.50 and dropped to 27.60 in the May contract leading into April 7th. And that not only fulfilled that entire wave structure, not only fulfilled the downside objectives for the whole sell-off, it also now, because of the time that had lapsed, it took silver right down to some very critical, very pivotal rising indicators, time price indicators that I follow. And that combined with all the other fulfillment tell me that should be a major bottom in silver. And I was saying this as it was happening, and we've seen an initial sharp rally from that, recouping about more than 75% of the sell-off. And now silver's in a bit of a consolidation below those initial rebound highs. But I think this is going to be one of those cases from the inverse perspective, where as gold potentially sees another quick, sharp sell-off from 34.50, potentially down to 31.50, that silver should see a correction, but it should remain above its April 7th lows, and then begin to trace out a more complex impulse wave higher in the months that follow. And I've already detailed in my publications where I think the next important peak in silver should be, and even where a potential multi-year high could be out in the future. And the real important thing about identifying those cycle highs is that often gold and silver will have the majority of their moves in the final weeks before a cycle of that magnitude, just as silver just did in the final 1 to 2 weeks before early April cycle lows came to pass. And so it had its entire decline in that final 1 to 2 weeks. So looking at those future cycle highs, that's the time too, as the markets start to trace out a developing uptrend and we get closer to those cycle highs, that's when you start to look for the accelerated move up, and there are different strategies can be employed at that time too, even dealing with options trading and other related vehicles of how to capitalize on not just an uptrend, but when that uptrend goes into an accelerated phase.
Does it look like the U.S. dollar has put in a recent bottom?
Well, like I said, my work has been showing that the dollar was likely to plunge through the majority of 2025. The dollar has already pinpointed where the most synergistic and most likely time for a future 6 to 12 month bottom is. But in between, yes, I was looking at that April time frame as the ideal time for an initial low, and I just need a couple of technical indicators to confirm that the dollar has put in a 1 to 2 month bottom, and already described as that bottom was taking hold, what cycles and indicators, price timing indicators, were lining up in June for a possible secondary high. So if the dollar can validate this recent low, and first thing I need to do is see it close above 100.19, 100.19 on the June futures, that would turn multiple indicators positive. In fact, I just detailed several of these yesterday in my May 7th alert. And that would be the thing that confirms to me that the April 21st low was in fact a multi-week and probably a multi-month low in the dollar. And it should start to hone some upside targets and also some confirmation or corroborating points along the way if the dollar is going to see an overall rebound into June. And as I stress a lot of times when I'm discussing cycles like this, that doesn't mean that the dollar goes straight up from April 21st into June. All that means is that June should time the final high in a rebound. So even in theory, you could have a big rally now up to 104 or something like that in the dollar. That could happen in a couple of weeks, and then it could just consolidate for several weeks until June and see a real quick spike high and then be right back down. That would still fulfill a cycle like that, just as what we were just discussing in silver, that April had been the time frame when a major bottom was most likely in silver. And that didn't mean that silver went straight down from late October into April. All it means is that April cycle low should see a spike below any intervening lows of that correction. So all that to say is I think the dollar is putting in a bottom. It needs to give me some additional confirmation, but there's enough technical support that says, yes, we've set a multi-week, probably a 1 to 2 month bottom, and we just need to get up above that 100.19 level and close above it to start to verify that and start to project some higher prices.
The Canadian dollar's been moving higher since the beginning of February. Does the Canadian dollar continue to look bullish?
Canadian dollar has, as you mentioned, looked pretty strong, although, as I discussed in my May Inside Track, the month of May is a time when we see a pretty consistent 8-month cycle in the Canadian dollar come back into play. So from that perspective, I think that May could time a pretty significant peak in the Canadian dollar, likely a multi-month peak that could be as short as 1 to 2 months. It could be more than that. The price movement and the technical indicators after that peak are what need to kind of clarify that. The cycles just give you kind of the backdrop or the foundation from which to build a trading strategy. But I have been looking at the Canadian dollar right up near 73 on the June futures. In fact, the strongest resistance is right around your November highs, and in that contract, that's right around 72.80 on the June Canadian dollar. So that's a critical level of resistance, and the way the wave structure of the Canadian dollar since its early February spike low and its early March secondary low, the way that has unfolded, a brief spike above 72.80 would be the perfect scenario for timing an important high in the Canadian dollar, and then seeing it enter at least a multi-week correction, consolidation. From there, I would expect it to drop back down to at least 71 and then see what it does there to determine what I expect moving forward.
Does it look like crude oil could have put in a double bottom?
I do think that crude is setting a near-term bottom. It certainly has had a lot of negative news thrown at it over the last couple months, both with the tariff issues and the fears of slower growth, and then OPEC Plus coming out and saying, oh, we are just going to open up the floodgates and start pumping this oil. It has taken a lot of that bad news, and it certainly it just retested that 55 support on the June crude futures. And I do think we're going to see it kind of stay in a trading range between 55, 56 on the low end and 64 to 65 on the high end. But there are cycles coming into play in June that would still allow for an additional spike low at that time before a more significant bottom takes hold.
Bitcoin's been moving higher for the past month. Could Bitcoin see new highs?
Absolutely. The way in which Bitcoin sold off into early March and then gave that a very brief spike below that, the early March lows in April, everything about that move said that Bitcoin was holding its multi-month, multi-year uptrend, and that as long as it didn't break below the 74,000, 74,500 level, that it should go back up and retest its highs. And there's even some upside targets I have above those highs that I've published for my subscribers that I think Bitcoin could reach. And in the meantime, I've been discussing why I think Ether could see a quick surge to about 2,200. Ether has just been languishing down. Well, it spiked down to 1,400, been languishing around 1,800. But all of my work is showing that it needs to see a surge to at least 22, maybe 2,300. potentially by the middle of May, which is when some of my daily cycles are looking for a top in all of the cryptos. But that's the thing that I've really been looking for is Ether to break above its late April highs right around 1850 and then take off up to 2200, 2300. So that's something that I think will coincide with Bitcoin surging to new highs.
Where are interest rates in their cycle?
Interest rates are in between a 3 to 6 month cycle that, and I'm going to quick pivot and talk about bonds and notes, which are inverse to the actual interest rates. But the cycles in bonds and notes are looking for a future peak in the July timeframe. Early July is when pretty large synergy of daily, weekly, and monthly cycles are coming into play. But until we get closer to that time, I would, with great conviction, say that should be the final peak. But ever since the January lows in bonds and notes, and then when they fulfilled projections for a rally into early April, that set the tone for interest rates, and it reinforced that early July is the ideal time for the next high in bonds and notes. So now flipping and talking about interest rates, the modest drop from January into April in rates, and then the sudden spike up after the whole tariff discussion, and suddenly some of your more astute traders realized that there are a lot of other weapons that other nations could use to combat the trade war, and one of them would be selling some U.S. debt. All of a sudden, you saw bonds plunge and rates spike back up right after the trade war talks took hold. But I do think that we're going to see some range-bound trading, and then as we get a little closer to that, into the June-July timeframe, that then you'll probably see interest rates tick down and bonds rally back to and above their early April highs as we head into that more significant and more decisive time frame in early July.
Where is inflation in its cycle?
Well, with something like inflation, my focus is really on the broader multi-year cycles, and I published several articles and reports back in early to mid-2020 that explained why I thought the 2020s were going to be an inflationary decade. And back then I explained, and these reports are still posted on our website, so anyone can go and see what I'm talking about and see when it was discussed. But my first objective was to see price inflation see a big surge between mid-2020 and third quarter of 2022 and then taper off from there. I think that we could see an intervening low in 2025. And one of the things I watch is the Goldman Sachs Commodity Index as one of the gauges of that price inflation, commodity price inflation. But I do think that we're in store for another round of price inflation out in the second half of this decade. And there are some more specific cycles that are honing that outlook, but that's the broad stroke perspective. And as I say, that is at its very core commodity price inflation that I'm discussing. So, sometimes some of your inflationary indicators and reports don't show it as quickly or in lockstep with the movement in the commodity prices, but that's what I'm referring to in this discussion on inflation.
The lithium ETF, LIT, has been moving higher, but lithium carbonate, the commodity, has moved lower. Could the lithium stocks and lithium, the commodity, be in different cycles?
Well, that's pretty much an ongoing phenomenon between the price of an actual commodity and the price of any stocks that are related to that commodity. And depending on how much separation there is between the price of that commodity, you could have wide variance and wide divergence between the commodity price and stocks or stock indexes or ETFs that measure the price of related companies. Something like a gold miner has a little more direct correlation to the price of gold. Although as you get into how the companies run, what the expenses are, what there might be currency rates and fluctuations involved, a whole litany of things that impact that the price of that stock, but you have a little closer correlation. When you start to introduce a couple levels of separation, then it's very ill-advised to try and correlate one to the other, to try and trade certain lithium stocks to the price of lithium, because there's so many other factors in the calculation of that stock price that outweigh the actual price of lithium. And I think a lot of traders, for some reason, don't see that, and it's a very clear-cut, very kind of in-your-face anomaly there. But like that LIT, I believe that's the lithium battery tech ETF. Well, you start getting all those additional factors in there, and the raw price of lithium is just a small factor in how those stocks are. Now, the other thing is to look at how that rally that you're discussing, how that fits into the broader scheme of things, or the movement of the last couple months, the last 3 to 6 months, the last 6 to 12 months. People that are perennial bulls for lithium and constantly want to find something that's going to justify a new raging bull market. Right now, they're going to look at that ETF, and maybe it is an early warning sign. But ask yourself where the price of lithium is compared to, let's say, November, December of last year, and where that LIT ETF is compared to November, December of last year. Lithium is actually right where it was trading back in November, December. In fact, we're just getting down to the November lows, which were major multi-year lows in lithium. So that is a critical support level in the price of lithium. But if you had bought lithium back in November, you're about break even. If you had bought the LIT ETF, which was trading between 44, 45, 46, and right now it's trading around 37, you'd be pretty seriously underwater. So even this rally in that LIT ETF is just trying to recoup some of what was lost between early October and early April, which incidentally was a perfect cyclic move in that ETF. You saw one of the most common multi-month cycle movement where it dropped from October 7th down into January, first week or two of January, completing a 3-month 90-degree decline, and that projected a future low 3 months or 90 degrees later, which is exactly when you saw the LIT ETF bottom on April 8th, almost precisely 6 months, 180 degrees from the October peak. So it has followed some very close cyclic regularity, but it has traded like a stock. The reason that ETF went from a peak of 49 in October down to a low of about 31.50 is because it trades like a stock. And so as stocks in the stock market were going through that 17-year cycle, that 30 to 40% plunge, so was that ETF. So the fact that it has recouped some of those losses is certainly a positive thing, but it doesn't necessarily say that lithium itself is out of the woods. So they're definitely in different cycles because the one is a commodity and the other is a stock, basically.
Eric, where can people subscribe to Inside Track?
They can go to our primary website at InsideTrackTrading.com. That's inside with the two I's in the center of it. So it's INSIIDE, tracktrading.com. And you can go right to the order button to find out the subscription we offer, or you can spend some time going through a lot of the technical and cyclical tutorial information we have on the website, a lot of the samples and archived reports, all of which detail much of this, some of the past analysis that I've cited, as well as current and future analysis, and find out just a lot of information about the services we offer. And that, again, is the best place at INSIIDE, tracktrading.com.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. He was speaking to us from Central California. Coming up, Martin Straith, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
Oh, my pleasure, Jim, as always.
Well, there's a lot going on today, especially with trade and tariffs. The U.S. and U.K. just announced a trade agreement. We have tensions rising in India and Pakistan with real bullets and shells passing across both borders. How are you reacting to all these news items? I'm really curious, too, about the U.S.-U.K. trade agreement.
Yeah, I mean, I think you go a bit crazy as an investor if you react to every bit of news that you see on CNN. But we're technical traders, so we try and keep the noise out of there. So we follow the charts. The markets hate uncertainty, and all this tariff noise. It's almost hourly. And remember, back on April 2nd, we had, Liberation Day, and then we saw the markets, like volatility just ramping right up. After that day, for 8 consecutive days, the VIX volatility was up over 30. That's extreme. Now, if you're a swing trader or a day trader, those fluctuations, they can be great opportunities. But we're generally longer-term investors. Certainly our subscribers are. So we stick to kind of longer term, and that's good because you can kind of keep the noise out of there. But certainly investors have been buying the dip lately. We had 9 up sessions in the last 11 days. Right now the market's kind of just about neutral, but if it can hold up, that would be 10 out of 12 days. So, Yeah, the news, there's many balls in the air for sure. Like I say, India, Pakistan, I mean, that's frightening. Both of those countries have nuclear weapons, and they've never gotten along, and this escalation could be pretty spooky. We've got Israel has just resumed bombing Lebanon. We've got China, increasing military activity around Taiwan. Now, like I say, the positive, we got the U.S. and U.K. trade deal. We got Trump. He's just removed the AI chip export restrictions, so that gave a nice boost to the semiconductors. We're seeing corporate earnings looking good. But the challenge, in deciphering all this positive economic news that's been coming out, a lot of companies and consumers, so they've been front-running these tariffs. So you're getting a bit of a false reading. I think what's going to happen is, in a few months, we're going to start to see the real effect of these tariffs. And also, if we go back to that trade deal in the UK, I mean, that's a framework deal. That's, kind of a gentleman's agreement. We were just talking before here. I just saw an article, and I just read the actual document. And at the very bottom of that, this great free trade agreement between the U.S. and the U.K., the document, the last line on it says that the U.S. and U.K. recognize that this document does not constitute a legally binding agreement. So, I mean, this stuff is just noise, right? So, and how are you supposed to trade that? It's kind of wild. So again, these deals, even if, we've got China and the U.S. Working on a trade deal this weekend, and the markets will react to that. But, then the realization will probably come out that, well, wait a minute, they haven't really agreed to anything. And of course, we've got the great anticipation. I mean, even today, Trump, he just posted threads saying he thinks that maybe they'll cut the China tariffs to 80%. And then he says, well, but that's up to the negotiators. I mean, that's how Trump operates, right? He likes to start with some ridiculous number, then he cuts it in half, telling people how generous he's now being. He posted another tweet saying that we need to open the markets and that closed markets don't work anymore. And you can kind of go like, well, hello. I mean, we had Canada, U.S., and Mexico had an open market. We had a free trade agreement. I mean, Trump bragged about the U.S., Mexico, Canada deal. I mean, he called it the greatest trade deal in history. So, these news updates are going to continue probably hourly. Again, for us, we're technical, so we watch the charts. We try not to listen to the mainstream media. So right now, you've got the S&P 500 trending higher. We highlighted to our subscribers recently that we're approaching a very strong resistance range between 5,700 and 5,800. And, today what are we at here? About 5670, just getting near the close here. So technically, prices are trying to establish a new leg on the very low volume and very persistent algorithmic trading happening here. So again, 57 to 5,800. If the stocks can break through that would be very positive. But with such low volumes and declining open interest, which is another technical indicator we look at, we expect that this rally is probably going to stall out soon. Again, we could get some positive news on this weekend that, China, they've done a deal. That would probably pump the markets short term. And then the realization would probably kick in that, it's probably one of those buy the rumor, sell the news events. So key resistance, 5,800. Key support would be 4,800. But, again, Jim, we're in a world right now where the president of the most powerful country and his administration are tweeting out recommendations for buying stocks and securities. I mean, yesterday, Trump sent out a buy signal. He said, buy stocks. You'll never get a better time. The S&P 500 immediately jumped higher because people thought, oh, well, there's some news is happening. Something's breaking. And then the market just crashed back down at the end of the day because nothing actually happened. It was just noise. So interesting times, Jim.
Mattel's CEO said this week they'll not be producing toys in the U.S. even with China's tariffs on Chinese products at 145%. He stated that manufacturing in the U.S. is not economically viable and that the tariffs will now force them to move out of China to find some other country to produce their products. What are the chances many of these companies pack up and move operations to the U.S. as these tariffs are intended to force them to do?
Yeah, I think that we're starting to see, I know we talked when I was on last month, that, you have to really look at, if you're a company, how can you operate in this kind of environment where there's tariffs, and then the tariffs are taken off, and then, another day they're back on. So I think that, the Mattel guy, I think we're going to see more and more statements like this from more and more companies, especially companies that are producing low-cost products. Because, as you say, he's not going to be moving production from China into the U.S. Like he said, it would not be it would actually be cost prohibitive to move to the U.S. They're talking about higher, you'd have higher labor, higher operating costs. He says that the U.S. supply chain infrastructure is far inferior to the system that China has built up over the last few decades. So the real issue is that the Trump administration has been telling and trying to sell the idea that these tariffs are going to be in place forever. And yet the track record right now, in the couple of months that he's been in there, this flip-flopping on whether a tariff is on or off, what company is going to spend billions of dollars over the next couple of years to build new plants in the U.S. if they can't be sure that these tariffs are on? Companies can deal with anything. If they know that there's a 20% tariff and the price is that, well, then they can react to that. They can plan for it and they can deal with it. But if they're going to spend billions of dollars and then not know that the president's going to change his mind, and or whether he's even going to be around in 4 years. So I think it's going to be very interesting to see what actually happens. Again, this is a real problem for companies. And then as an investor, are you going to invest in companies that say, yeah, we're going to move and we're going to spend billions of dollars to relocate? Wouldn't you start questioning the leadership of that company? Because what are they getting into? They're going to have to pay a lot higher wages. They're going to have to pay a lot higher operating costs. It's going to be a real challenge. So I think that, for me, the only way that companies are going to be willing to spend and relocate to the U.S. is if they know for sure these tariffs are going to remain in place and they know what the tariffs are. And I don't know how that's going to happen the way things are going right now. They need certainty, and right now there is no certainty. So they need, if you're going to do a multi-billion-dollar investment, you better know for sure what the rules are. Okay, so now one of the other things, I mentioned this last time I was on, the U.S. unemployment rate is near historic lows. So you have to wonder then, where are all these workers going to come from if all these companies were to move to the U.S.? If you're a company like Nike or some other clothing or sporting goods company that, is already charging, a couple $100 for a pair of shoes, who's going to take those low-paying jobs? The other piece to me is you look at the tech sector. Tech workers in Taiwan and India and China, they're willing to work for $5,000, $10,000 a year. In the U.S., that same worker is going to want, $100,000. And then, and that gets even more the higher up that you get into that skill level. So the bottom line to me is it doesn't make a lot of sense to do this blanket kind of tariff approach and wanting all sectors to move to the U.S. Why would you want cheap, low-paying jobs in your country? You want to have better-paying jobs if you really want to improve the economy. So, again, the U.S., they don't have enough workers to fill all the jobs, assuming all these companies would move in. To me, international trade is great for everybody if it's done right. So hopefully we just get some resolution here. We get whatever the tariffs, whatever the rules are going to be, and then get on with, building the global economy.
Well, also, where are they going to find the workers for these steel and aluminum plants? A survey done by Morning Consult of 1,000 Gen Zers found 57% of them want to be influencers. That doesn't sound like somebody who wants to work in a steel mill.
Yeah, there you go. Maybe they can influence steel production.
President Trump keeps badgering Fed Chair Powell, this week calling him a fool for not cutting interest rates should the Fed cut rates.
Yeah. It's amazing, isn't it, the way the stuff goes on. The one thing that is interesting is that, when Trump's first term, all he talked about was the stock market, right? And he used that every day. He would reference the stock market, and that was his kind of proof that the economy was doing so well. But this time he hardly mentions the stock market at all. And when he does, typically he says, be a little bit of pain here, whatever, but we'll be fine. And then, of course, yesterday he says buy stocks. Now, his Treasury Secretary, Scott Bessent, this guy is a former large hedge fund manager. I think he's worth about $500 million or a couple billion, whatever. So this guy knows the market. Wall Street kind of refers to this guy as the smartest man in the room. So when he speaks, he's very clear that he wants to get the 10-year bond yield lower. He wants lower interest rates. And that's pretty simple because, he wants lower rates because rates, that's costing businesses, it costs households, it costs more, it's mortgages, it's all of that stuff. So all he wants to do is, cut taxes, deregulation, spending cuts, and he doesn't talk about the stock market. He talks about bring down inflation, which is kind of interesting given all these tariffs, which are looking like they'll be pretty inflationary. But all of his talk is designed to stabilize long-term yields rather than worrying about short-term stock market gains. But right now, the yields have been rising, and that he's not liking that. We know, like on April 4th, so this is just after that Liberation Day, we saw the yields drop down to, 3.7%. But today they're almost at 4.4%. So these yields are much higher than what Trump or what Dissent wants. And, you got rising yields. That suggests the stock market is worried about higher inflation. And when you get higher inflation in a slowing economy, that's called stagflation. And stagflation is kind of the worst economic scenario you can have. And stagflation makes it very difficult for the Fed to cut rates because if they do, that's going to feed the inflation again. So the Fed's in a tough spot. So while Trump calls Powell all kinds of names, if Powell were to cut rates, like I said, that's going to add to inflation. Now, rising inflation makes borrowing costs more. So again, for people, companies, and for government. So then, why are bonds falling and yields rising? Well, simply you've got the U.S. they need to borrow between $7 and $8 trillion of new debt this year. And that's to cover current and future spending this year and to cover maturing debt from all the previous deficits before. And remember, the U.S., they're running deficits at, $2 trillion a year. Their total debt is almost $37 trillion. So now we've got the U.S. and China in the trade war. We know that China is the largest or second largest holder of U.S. bonds. And we know that last time that when the bond market or the stock market sold off, Trump paused reciprocal tariffs on countries because he's worried about that the bonds are going to, sell off. So if China were to threaten to sell the U.S. bonds at the same time that the U.S. needs to issue trillions of new bonds, that would drive the price of bonds down and yields higher. So I think it's going to be very interesting this weekend, the trade talks. That China's got that card on the table. So, and again, we've got many foreign countries they're pissed off at Trump. So why would they want to buy U.S. bonds and support the U.S. economy at the same time the U.S. is threatening everybody, including their closest allies? So I think it's fascinating. If yields keep rising, getting closer to 5% or even higher, that would cause real problems to the U.S. economy, and that would push the stock markets lower. So I think this is all It's all connected, Jim, and it really does, it really puts the Fed in a tough bind here. And, Trump can call them all kinds of names all he wants. I don't think Powell's going to budge.
What do you see for the U.S. and Canadian dollars?
Well, I say this all the time. It's all connected. So higher U.S. dollar means lower currencies for the other currencies. U.S. dollar goes down, other currencies go up. And we've certainly seen that recently. We saw the Canadian dollar was up about 72 cents. And that was because the U.S. dollar had been declining since the late or mid-August, I guess it was. Now, very interesting thing that we saw this week, and you didn't see much of it on the mainstream news, but the Taiwan new dollar, the new Taiwan dollar, it jumped 10% last week against the U.S. dollar. And what happened there was that the Taiwanese companies were selling off U.S. assets and converting them, converting the proceeds from those sales of the U.S. dollar back into their own currency. And this is something we talked about last month, is that, these other countries can sell off, if they decide they want to, not support the U.S., well, you sell off your U.S. assets, you take the currency from that, convert it back to your local currency, and all of a sudden you're pushing the U.S. dollar down. And that's what we've been seeing for the last few months here. Now, this week, we've seen the U.S. dollar rising. I think part of that was, all this kind of positive vibe about, we got the U.S. and U.K. trade deal, which, again, we just talked about that. It's not really even a deal. And we've got optimism that China and the U.S. are going to talk this weekend. So, that gave buzz to the U.S. dollar. Now, the bigger picture, due to trade wars, again, we've got many foreign pension plans, other major institutions looking at selling U.S. assets because they're getting pressure. Certainly in Canada, that's happening. Canadian Pension Fund has been getting a lot of pressure to, reinvest into your own country, help support the Canadian companies. So if that happens, again, just like in Taiwan, we're selling, U.S. assets, converting those U.S. dollars back into currencies. So again, that's been going on. Last month when I was on your show, actually, I said that the U.S. dollar was very oversold and that we should see a trend change. And that's exactly what we've seen over this last few weeks here. So, and you look at the Canadian dollar, it dropped all the way down to just over 68 cents back in February. That was a 23-year low. But since then, again, with all the tariff news and the U.S. dollar tanking, the Canadian dollar jumped up to about 72.5 cents last week. Now, this week, with the strength in the U.S. dollar, the Canadian dollar now has dropped down to about 71.75. So we're about, 0.75% down. So new support here for the Canadian would be about 70 cents. As I say, Jim, it's all connected, and it's heavily driven by what happens in the U.S. dollar.
Gold's been very volatile this week with big gains and some losses. What's your take on gold?
Yeah, well, gold hit, it hit an all-time intraday high on, what was that, April 22nd, 23rd, I think it was. So at 3,500. But since then, it's been consolidating. If you look at the seasonality chart, from May till kind of the end of June, gold kind of consolidates. It just kind of goes up and down. So it's doing exactly what it's doing right now. But when you come into, late June, though, early July, that's when gold has one of its best parts of the year. So I think, hopefully that's what we get now. And, we're trading a range right now between a low of 3,200 to a high right now this week of 3,430. So we're up about, what are we at here? About $40 right now today, about 33.45. So from the start of this year to that recent high at 3,500, I mean, gold was up 35% in just over 4 months. Now, the recent strength in U.S. dollar has been a bit of a headwind for gold. Again, the main driver for gold rally has been central bank buying. Before the tariff war, we already had some serious trust problems. We've talked about this before, when the West seized all the Russian assets after they invaded Ukraine, and they kicked Russia off the SWIFT system. that just warned countries not aligned with the West that the global financial infrastructure can and was being used as a geopolitical weapon. So you got China, Russia, Iran, those kind of countries who basically don't trust the West. So they started to buy gold, and they've been doing that for the last year and a half now, and they've been buying a lot of it. So today, with all the trade tariffs and the conflicts intensifying globally, I mean, that just gives the central banks even more reason to buy gold. So, and also I guess we've got retail investors. They're looking for a safe haven. They're starting to realize, again, with all this, Trump noise and trade talk, it's really like, well, what's really going on here? And they're also realizing that the purchasing power of their currencies is dwindling. And so safe haven gold is becoming a pretty popular thing again. So gold's up, like I say, about $40 today. Next resistance is about 3,400. The next test would be 3,200. And then there's really strong support at the previous down part at about 2,960. And that's the low we saw last month. So I'm expecting to see a test of that 3,200 unless we see some geopolitical jolt. We're certainly watching Pakistan and India. You've got to keep an eye on China and Taiwan. But if we don't have anything like that, I can see that we should hopefully hit at least the 3,200 and hopefully down to 3,000 and give people another opportunity to kind of reload and get back into it.
When you last talked with us about Bitcoin, you highlighted 72,000 to 74,000 for support, which it hit, then 92,500, then 100K for a target high. All those levels were hit. So what now for Bitcoin?
Yeah, Bitcoin, it's done really well during all this kind of tariff turmoil. We've highlighted previously how it's acted very much like the stock market, much more than like a safe haven play like gold. But then, around, April 10th, I think it was, Bitcoin kind of decoupled from the NASDAQ. So it no longer was trading like the NASDAQ did, and it actually started trading more as a safe haven play. And now we're actually seeing, now it's kind of back in sync with the stock market, and it's actually leading the stock market. So it's been quite a very interesting month and a half here. And as you say, on Thursday, it was up $4,500. So that took us up to about 102. Today it's trading about 103,000. So as you say, that 92.5K was a very, very key resistance level because that was a very strong support level for Bitcoin right from late November all the way through to late February. And then in February, when it fell through 92.5, we did say on your show that we expected 72 to 75K. And it hit 74.5K right on April 9th. And since then, it has just ripped higher, and it's up 37% since that. So we're up 37% in about a month. So what's driving Bitcoin? I think it's a combination of things. I think we've got obviously Trump pestering Powell to cut rates, so you've got that kind of turmoil happening. Another could be China has been ramping up stimulus ahead of the trade talks, so that's another kind of factor in there. And yet another is the realization by most people getting more and more aware that there is so much government debt globally that fiat currencies are dramatically losing purchasing power. And, for whatever the reason, people are now starting to realize that Bitcoin could have and should have a play in their portfolio. So I just think that Bitcoin, it's going to continue to be very volatile, but I can easily see it retest its high at 108,000. And if it can hold above that, on its way to 200,000. But again, it could easily, break. If it breaks below 90 or 92.5 again, then you're going to have another good buying opportunity.
Can you remind our readers about your new DeFi Digest? And what does DeFi stand for? Your DeFi Digest newsletter, and is it still free for our listeners if they sign up now?
Yeah, well, DeFi is decentralized finance, and we've the first issue went out about a month ago. The next issue actually will go out in about a week. So, and it's still free. So, if any of your listeners want to get on the list, just email us at info@thetrendletter.com, and we'll add you to it. So, what it is, DeFi is basically leveraging the blockchain technology, and it's to deliver financial services. And the key here is it's delivering them without traditional intermediaries like banks. So it's built on decentralized networks, so something like Ethereum. And, to put it into some context, I guess, it's very, I see this as very similar to getting in on the ground floor of a new financial revolution, just like people did, when they got into Bitcoin a decade ago, or when they got into internet stocks, back in 2000. So the opportunities, DeFi is not just a buzzword. It's a real paradigm shift in how we make financial transactions. We're talking about peer-to-peer financial transactions on blockchain technology that's open to anybody. And this is the key, to anybody who's got an internet connection. No paperwork, no middleman. So we've got the world's largest banks. You've got, JP Morgan, you got BlackRock. They're predicting $15 to $30 trillion market for real world assets in the next 10 years. Think about that. That's a big, big market. So we're talking about making digital transactions on a huge range of assets, from corporate and government debt to real estate, fine art, commodities. I think I used it on your show last month. Example of, somebody has a commercial building. Well, a commercial building, maybe it's worth $25 million. Well, you and I, Jim, probably can't afford to buy it. But on DeFi, you could buy a piece of it, So they can split that into, thousands of millions of pieces of it, where as an individual, you could go, well, I don't have 20 million, but I wouldn't mind investing 10,000 or 15,000 into that. And then all of a sudden you're a part owner of this building. And for somebody selling these assets, we've seen racehorses being sold this way. We've seen works of art being sold this way. And it's a cool thing. People can say, hey, I own part of that racehorse, or I own part of that painting. And I don't have to invest $1,000 or $10,000 or whatever amount you wanted to. Real estate. There's places in Florida where you can buy a piece of a vacation home, and you get part of the of the revenue generated from that. You get voting rights on what you're going to do, what kind of money to be spent. The more tokens you own in that property, the more say you have on what happens. So again, it's and another one, of course, is online gambling. You think about that. If you're online gambling in one of these offshore places, you have no idea how rigged that game might be. But if you do it on a DeFi platform, you could be betting peer to peer with other gamblers using smart contracts, and that removes all the centralized control, and it allows the players to bet directly with each other. So I could go on and on this stuff, but it's a real game changer. And I'm sure a lot of your audience goes, I'm barely even comfortable with Bitcoin. This is even different. But again, if you've got some money and you're a speculator and you want to get in on some of this stuff, one of the items that we was in our first newsletter, there's just a new buy price going out there. So again, that's probably going to come out in the next week or so. So, you've got activities right now. Again, if you wanted to get in like internet and Bitcoin, I think this is the kind of opportunity. But you have to understand that there will be a big learning curve. Just like, early investors in Bitcoin had to learn new terminology and tools, DeFi investors are going to learn, they have to learn and master things like digital wallet, private keys, smart contracts, But that's what our DeFi Digest newsletter is all about. It's to address those challenges, provide guidance to help subscribers work their way through the process. So again, the learning curve exists, but if your listeners are out there and there's somebody who enjoys exploring new technologies, wants to be part of a game-changing revolution, then check it out. And then, like I say, it's free right now. We're going to leave it free for the first couple of months. What we do ask for people, though, when they sign up, that they give us feedback, because that's really what we want to do. And then we will start charging for this. But right now, people want to get ahead of the game. Again, first few months, it's going to be free. And again, so info@thetrendletter.com, and we'll pop you on the list there.
I know you agreed to offer our listeners a special discount of between 33 and 57% off the regular subscription prices. Can you remind our listeners what they can get?
Yeah, we've got a bunch of stuff there now. Okay, we got the Trend Letter. So that was our original flagship product. So that's in its 24th year now. Hard to believe. Time flies. Weekly publication. It's for longer-term investors, and it's really for people that want to understand what is driving the markets. So we cover basically everything. We cover equities, currencies, precious metals, commodities, and bonds. The second one is our Trend Technical Trader. So that's an online service, updates every Monday, Wednesday, and Friday. It's for both active and longer-term investors. It started out as a hedging service and still does a lot of hedging. So when we had that, market crash there, when market was down 20%, we had the hedges on there did really well. So that comes out, like I say, that's about 3 times a week. Again, and it covers, precious metals, commodities, and it includes our proprietary gold technical indicator. The third one is, this is our Trend Disruptors. Now, this is for speculators with risk capital available. Service invests in disruptable ideas. So we're talking, AI, virtual, augmented reality, 5G, cloud, Internet of Things. So those are our 3 paid services. As I say, you can get 33 to 57% off. So basically, what the price is, instead of $600, you get now $400. If you buy 2 of them, instead of $1,250 or so, you're paying $600. If you buy all 3, instead of paying $1,850, you're only paying $700 or $800. So you're saving over $1,000. Now, and we do have right now our 2 free services. So that's the DeFi Digest, which we just talked about. And then we've also have our headline service. And that's where every morning we go out and we look at the headlines. And we look at headlines that investors need to be aware of. So it's not all just the mainstream talk. A lot of the stuff, some of the stuff we put out there, you won't even find on CNN and so on. So that's free. Like I say, it comes out every day. People can read the headline, and if they actually want to read the whole story, they just click on the button and go read the actual story. Again, so if you want to get onto that service, again, just email us at info@thetrendletter.com. And then for those specials, Jim, we'll pop up we'll put your logo, I guess, on our front page, and people can just click on that and go right to the special offer.
Martin, thank you so much for being on This Week in Money.
Oh, always a pleasure, Jim. Great talking to you before and after we do the broadcast. And by the way, for your audience, happy Mother's Day to all the moms out there.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. Coming up, Hilliard MacBeth, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the 2nd edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, MacBeth.Partners.com. And you can find him on X at HMACBE, HMACBE. Welcome back to This Week in Money.
Nice to be back. I'm talking to you from Mexico, so we say hola, hola.
¿Cómo estás? And all that. I don't know.
¿Cómo estás?
Oh, yes. Well, there you go. Mixing Spanish and French. My fault. I'm as inept in both. The second edition of your book, When the Bubble Bursts, is on sale now. Where can our listeners get it?
They can get it on any of the electronic platforms like Kindle and Kobo and all that, and then the bookstores will have it, or they can order it if they don't have it in stock. But with the real estate markets in Toronto especially dropping now, the book describes a lot about what sort of thing is starting to happen in the cycle. The housing cycle is happening now.
So what's the latest on Canadian home sales and inventory?
So the inventory is soaring, and the sales are pitifully small. So, and we've talked about this many times, but there's this standoff you get to where the sellers remember a price from 2022 that they still think their home is worth, and the buyers realize that the market is really weak because they can see all the for sale signs. So the buyers are only willing to bid like 70% of what the sellers think that they should get, and the gap is pretty wide, and there's almost no way to bridge the gap. It just sort of comes to a standstill. So I read recently that the home sales in Toronto are basically the lowest they've been for 30 or 40 years. So people are just sitting. But what happens is, this won't last forever. What happens is the houses where there's a lot of money owed, or the condos, the lender eventually takes over and forces the sale. The lenders aren't as sensitive to price; they just want to get it done. They just want to get it off the books, kind of thing. So that would be the next stage that would probably already started to happen in some places.
Do sellers need to price their homes for where the market is today instead of where it was yesterday?
Well, I think they need to think about how long do they want to be stuck with this? Because if we're just at the beginning of the bubble bursting, it could be, in the U.S. it was 6 years, 2006 to 2012, and you don't want to be chasing it down. So you might as well get ahead of the flood. Eventually people will start adjusting their prices, and you might as well be one of the early ones, because there probably are still people sniffing around. But the problem is that the sellers get insulted because they feel like the bids are way too low. There's an emotional thing that gets involved.
And of course, in Vancouver, anywhere between 40 and 50,000 people a year move into the Lower Mainland, which is like 22 communities, but they're all clustered around Vancouver and then Vancouver itself.
Yeah, there's quite a debate raging on X about that. That one of the longtime a friend of mine, Ben Rabideau, he's been the analyst on this since 10 years now, at least. And he's saying that the influx of people, now he's talking more about, he's based in Toronto. He's saying the influx has changed, is really slowing. So these people that were being let in by the previous government in Ottawa, that's not happening as much or nearly as much anymore. And so, that'll change. It's already changing. There's so many condos in Toronto that are not being sold. They when they can't sell them, they turn them into rentals. And now there's quite a bit of supply on the market. But you were talking about Vancouver. I don't know Vancouver as well as Toronto, so I'm not sure.
After sales, I was going to say, after sales drop off, how long does it take for prices to drop substantially?
Well, it depends if it's a cycle, like it is the normal cycle, or if it's a crisis, like a bursting of the bubble. So my thesis, of course, is that the bubble is going to burst, which means that it's when the lenders get involved. So the lenders are not getting their mortgage payments anymore, and they force the sale. And that's different. You don't get that in a normal cycle. It comes along every 5 or 10 years. This would be something like the 1990s, which is now, 30 plus years ago. So we haven't, most of the people involved in this have not seen this before. This is, I've been doing this a long time, so I remember the 90s, an awful lot of people that are involved in it now weren't around then, or they weren't interested. So it's completely different. You get, like in the 80s and the 90s, you had massive numbers of financial institutions going under. They closed their doors or they got swallowed up by more healthy companies because they couldn't sell their properties and they had way too much debt outstanding. So we haven't seen that for so long. And in 2009, it could have happened, as I explained in my book. But in Canada, we managed the crisis without any failures of any banks or financial institutions, which was unlike any other country in the world. The U.S. had massive failures. England had massive failures. Spain, everywhere. But Canada sort of slid through it without any real trouble. So there were some behind closed doors, I would call them bailouts, but some people don't like that term, that were done, but it was managed very well. And so that extends the cycle, but it also makes, when the actual bursting of the bubble actually arrives, it makes it worse because the bubble's been extended and allowed to grow bigger.
Are we seeing a lot of foreclosure sales yet?
We haven't, we're seeing them in Toronto. We haven't seen them in Edmonton, Calgary, or Vancouver, as far as I know, as much. But what we are seeing is kind of interesting, is a lot of corporate bankruptcies. So the corporations, a lot of them are involved in the real estate, either as developers or speculators or builders or whatever. They're starting to show up in the bankruptcy numbers, and of course foreclosures in Ontario are really starting to increase in volume. So, but it takes a long time. I mean, people stop paying their mortgages, and they sometimes live in the home for 1 or 2 years. In the U.S., the average was 2 years. So you can live mortgage free for 2 years. Just stop paying your mortgage. The financial institution doesn't get around to kicking you out for a couple of years. So it's like, well, that's not too bad, But of course, then there's a black mark against your credit score for a long time. But so we won't know like that when the actual foreclosure sales start to really show up big time. If this is the big cycle, it'll be long after prices have come down quite a bit. And prices have come down, like in Toronto, 2022 numbers. Today, it's down close to 20% from there. And there's probably been about 15 or 20% of inflation. So you could say that after inflation, the market has declined 30 to 40% in some parts of Toronto already. And it's probably not over yet.
If the housing market tanks, will it likely be very tough to get a mortgage?
Well, that's what happened in the U.S. So we don't know in Canada, because the last time this happened on a big scale in the 80s and 90s, the rules were all very different. And the financial institutions, back then there was a bunch of trust companies and different financial institutions that offered loans to buy a house. They either went away or they got swallowed up by the banks. So now it's the banks. And but in the meantime, also the lawyers that deal with real estate, one of them I know in Edmonton, I think he told me he spent like 5 years getting all the legislation changed in Alberta. And I'm sure it was the same in Ontario. So they were trying to avoid having the same situation happen again. But so we don't know. We don't, to answer the question, we don't know what's going to happen this time because the rules are different and the institutions that are involved are different because they're banks now rather than some trust company that, that is pretty small potatoes. And we won't know how they handle it. I'm sure they're working on, between the government and the banks, are probably working on how to handle it, what to do, but we don't know yet what they're going to decide to do.
The stock markets have been moving higher for the past month. What do you see ahead for the markets?
So the stock market got quite, and now I'm going to talk about the U.S. stock market because that's the biggest, it's about 55 or 60% of the value of all the stocks in the world. And the S&P 500 is the biggest index. So they're the 500 most important companies. So it's down about 10% from the peak. And last year, I guess, was the peak. And it had gone up about 20% plus for 2 years in a row, which is very unusual. And then starting in November, right after the election, the market, well, not right after election, but a month or so after the election, the market started to go down. Then the tariffs stuff came out and the market went down further. And at one point it was down almost 20%. And, people have this rule that says 20% it's a bear market, 10% it's correction. So somewhere between a correction and a bear market. And now it's rallied for a month, and it's now down less than 10%. So it's come back quite a ways. But the problem is that the underlying issue was overvaluation and the likelihood of a recession. We haven't had a serious recession for 5 years, and that one was very short-lived. We haven't had a really serious recession for more like 15 years in 2009, 2010. So we're overdue for a recession, overdue for a bigger correction in the stock market, like called a bear market, because valuations got way, way too stretched with those big gains we had in 2022 and 2023, 2024. So here we are. And people are saying, well, there's going to be some deals made on the tariffs and stuff so that market can go back and keep going up. It's, we're talking on Thursday here. It was interesting today because Trump announced a deal with the UK. And then shortly after that, he said, it's a good time to buy stocks. And the stock market went up 1.5% right after he said that. And then by the end of the day, it was up only 0.5%. So people aren't necessarily convinced that the deals, either the deals on the tariffs are coming, or that there'll be enough of them, or that they'll be important enough, or even they suspect they might not even be genuine deals. Like this UK deal appears to be more like an agreement to agree after the details are worked out. So it's a precarious situation for the stock market. It's definitely not well supported by fundamentals. It's still got a lot of froth in it, and my guess is that the froth will have to be removed, which is done by having prices go lower, quite a bit lower than they are now.
Does it look like the U.S. dollar could have bottomed after the downtrend it's been in since the beginning of the year?
The dollar's about the same it was 5 years ago. I was, people have been talking about the dollar being so weak and all that, and the price of gold's gone up a lot. It's up to $3,300, $3,400, which is per U.S. So an ounce of gold has gone up in value, which is a way of saying that the U.S. dollar's gone down quite a bit. In fact, some people would say the price of gold's gone from $1,000 to $3,000. The U.S. dollar's lost 2/3 of its value, but against other currencies, like the Canadian dollar is a very important currency because of the amount of trade we do in that. It isn't nearly as dramatic, and so there are people that are saying that the U.S. dollar is in trouble because they're maybe not going to be in such good financial shape as they have been. They've got a huge deficit of $2 trillion a year, and we just don't know. I mean, the U.S. dollar is used in something like 85 or 90% of all the trade transactions in the world. A lot of that's oil, and so it's not going to be abandoned, in the next week or two. But it may actually start to become less important over the next 10 or 20 years. But I don't think in the next 6 months or a year, people need to worry about the U.S. dollar losing a substantial portion of its value. But if you are worried about it, buy some gold, because there's some gold mining stocks. That's the best way to hedge against the declining U.S. dollar.
The Canadian dollar's been moving higher since February. Where do you think the Canuck buck goes from here?
Yeah, so the Canadian dollar had a big plunge after some negative news about Canada came out a few months ago, and then it got down to I'm not sure 100% where it got to. I think it didn't get to 66 cents, but it got below 70 cents. It got to 68 or 69 cents, and now it's back up to 72 cents. So we've had a little rebound. Or you could say the U.S. dollar's come down a little bit because of your U.S.-Canadian crosses that we're talking about. But I think it's headed lower because of my belief about the housing bubble bursting. That would put downward pressure on the Canadian dollar, and there's an awful lot of money that's come into Canada to get involved in the wonderful real estate gains that have happened for the last 20 or 30 years. And if they see that the cycle is changing and those gains are not going to be had anymore, they'll be moving their money out of Canada, and that would cause the Canadian dollar to go down. And then, of course, we've got the problem too with Donald Trump, having this particular obsession with us, I guess, in Canada, and we don't know what kind of measures he's going to take, but certainly the auto exports are at risk, big time. The steel and aluminum exports are at risk. The lumber exports are at risk. So far, the oil exports are safe. He exempted them because they need our oil quite badly. But it's any sign of more trouble in that export market, which is very important to Canada, by the way. Trade is very important, and 75% of our exports go to the U.S. So that's the thing to watch. If you were worried about the Canadian dollar, then watch what happens with the trade with the U.S. and the tariffs and all those policies, because that'll be the decider as to where our dollar. But I think my guess is lower, below 70 cents again at some point.
Gold looks to be moving higher following a pullback. Do you have targets for gold?
Well, I don't have a price target for the gold itself, but it was $850 an ounce in 1980. I think it was February 1980. And when you adjust for inflation, it's basically back to that number. So if it hit 850, it went down all the way. It went down a lot. I don't even know how low it got, maybe 300 or something. And then it's been going up since the 80s. And it hit a high recently of somewhere in the 3,400 range or something. Yeah, it can go higher. There's no doubt. It's been out of favor for a long time. One of the reasons it's been out of favor is the kind of people that would speculate in gold had other options like crypto and Bitcoin and Tether and I don't even know all that. And there's like hundreds of them, right? So they've got all kinds of ways of speculating and enjoying that gambling instinct in the markets without getting involved in gold. But what that has created is a situation where gold is probably still undervalued, even at north of 3,000. But especially the companies that mine gold. So the companies that mine gold, now their inventory, if you like, which is in the ground, a lot of cases, is now tripled in value, and the stock market values have not gone up commensurate with that. So if the gold price stays at these levels or goes higher, then the gold mining companies are going to do really well, and they have started. The share prices have been moving up, but it could go quite a bit further.
Do you have any targets for silver after it's been moving higher?
No, I don't. I don't know about silver, but I do know one thing from past cycles. I remember everybody starts talking about silver. When gold's gone up a lot, like it has now, people start talking about silver. So I think it's because it's cheaper and they feel like they missed out on gold, so they jump in on silver. Silver's different in some ways because it actually is used in a lot of, almost all of gold supply and demand is based on people willing to hold it as like a monetary substitute. But in the case of silver, that doesn't happen. It's more about actually being used in things like solar panels and electronic components and that sort of thing. So as a monetary speculation, silver is not nearly as good as gold, but it usually gets a run when the gold gets going, then the silver gets going. But I basically only watch gold. I don't watch silver.
Canada's new Prime Minister, Mark Carney, and a minority Liberal government. Do you think a minority Liberal government will be good for Canada?
Well, I'm sure it'll be good for some things and bad for other things. It's like everything. There's always the positives and negatives. But I think it's a good thing that that Carney has managed to get a meeting in the White House with Trump, and he managed to get out without being Zelensky'd, is the term I saw.
Yeah.
He didn't get Zelensky'd in the meeting, so that was good. And but he faces some big hurdles. Like, this is bigger than him. He's done a lot of very high-pressured things at very high levels, among world leaders and that sort of thing. But this by far will be his biggest test because, well, first of all, he's new to politics. He's never run for office before, so he runs for leadership of the Liberal Party, wins that, and then he runs for Prime Minister, wins that. But he's only been a politician for months, so he's learning that. Then now he has worked in government a lot, so he knows how government works. So he doesn't have to learn that. But he's stuck in there in a situation where there's a lot going on internationally that so he's probably a good person to handle it. But what are the odds that Canada ends up having some real difficulties, or Canada could end up being a winner in this whole thing? There's no way to really tell. It's very much up in the air, and but probably he's better than some other people that could have been in there. Certainly, his predecessor, certainly better than that. And so we'll see. We'll just have to wait and see what happens.
Talk about Alberta independence is picking up. Could this cause a boom in Alberta real estate?
Well, I don't think it should. I remember when they had the referendum, I don't know if people remember this, but when they had the referendum in Quebec and they voted almost 50% to separate, if that's going to happen in Alberta, I don't know that it is, but there's been some talk about it by the Premier. The price of real estate went way down because people were trying to get out of Quebec because they thought that they shouldn't get caught in that with owning land in a jurisdiction that had left Canada. So, I don't know. It might work the other way, but my guess would be it would be a uncertainty in Alberta that people wouldn't want to get caught holding. I mean, I'm having trouble. This is probably controversial for a lot of people, but I'm having real trouble imagining what the big benefits are of being independent. We don't have in Alberta. I'm based in Alberta, of course. We don't have access to oceans, and it's very expensive to ship stuff by truck or rail or pipeline, or it's very expensive to build pipelines. They just expanded one pipeline and it cost $34 billion. So Canada paid for that, but if Alberta separated, there's no way Canada's going to pay for that anymore. So stuff like that. I mean, it's just all the frictions of dealing with being a different government, having to deal with hostile government in Ottawa, perhaps. Albertans complain that they're treated badly by Ottawa, but if they separate, imagine they're going to be treated 10 times more badly. So, and then how does the U.S. react? Well, the U.S. might, if they really are serious about trying to take Canada over, they might really enjoy Alberta separating because that helps them make their case. And it's. I don't think it would be a positive thing. I really don't see the upside, and there might be some upside. I just don't see it, but I can see, without even thinking about it a lot, quite a few pretty serious downside risks that come with it.
Are there advantages and disadvantages to BC and Alberta merging?
Well, you got the. What do they call it? What did Alan Fotheringham used to call it? Lotus Land, and you got the far right and the far left trying to get together. I don't know if that would work, but and of course BC has the additional problem of they didn't settle their native land claims, so they've got a number of issues dealing with that. So I don't think there's anything natural about that would work other than they're adjacent to each other. But I guess there would be some advantages because there would be access to tidewater. But just think about the currency, for example. What are we going to have? We're going to have a new currency in Alberta, or even as BC, Alberta, going to have a new currency. How's that going to be treated on the international currency trading markets? Is it going to be treated positively or negatively? What about the debts? Alberta's debt is pretty good, and I think BC's debt is pretty good as well. But if they have a downturn in oil, or if like almost all our oil from Alberta goes to the U.S., and the U.S. is the biggest producer of oil in the world now, so they maybe don't need our oil as much in 5 or 10 years from now, and that would be a huge blow to Alberta. So so it's probably better to be part of a bigger group than a smaller group. And Canada, all of Canada is 40 million people. It's not big at all. It's tiny, right? So to make it even, bring it down to 5 million, that would be very dangerous. Or combining with BC, which is, I don't know what it is, 8 million maybe, so it's 13 million. You're still not, you're so tiny that you're very vulnerable when you're that small. And I think we should move the other way. We should try and get more allies and grow bigger if there's a way to do it.
Yeah, well, I mean, I'm just thinking of Sao Paulo, Brazil County. It's 20 million, just one city.
Yeah, there's all kinds of cities in China that are
over 300, over 1 million.
Yeah, so I mean, who is Alberta? We just get like, now there are countries like Norway that are only 5 million. So Alberta and Norway are about the same population, 5 million. But Norway was smarter than Alberta, in that they saved their money from the oil and gas, and they now have almost $2 trillion. It probably is $2 trillion in Canadian dollars. It's about $1.5 trillion in US dollars. They're safe because they've got tools that they can use financially to safeguard their country. But Alberta doesn't have that. We don't have that, and Ottawa's not going to, or the rest of Canada, if Alberta tries to separate, is not going to give Alberta a good deal. They're going to give them a terrible deal. And because they're mad, right? And it's just not a good situation, So I don't know. It seems like there's bigger issues in the world that people should be worrying about than whether jurisdictional lines should be redrawn on the map.
Hilliard, where can people follow you, and where can they buy your book?
So they can follow me on X. That's fairly active, although since Elon Musk took it over, it's kind of changed a little bit. So I'm doing stuff on Blue Sky as well, fairly limited. Or they can go to my website at MacBeth.Partners.com and connect there. And we put out a weekend note every Friday, and we post it on X. But people can also sign up to receive it directly if they go to the MacBeth McLeod Partners website, and they can have it sent directly to their email every Friday. And it isn't always just about stock market. It's about all kinds of things like we've been talking about in this interview. So I think people find it quite interesting. So hope to connect with people if they want.
Hilliard, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Hilliard MacBeth, author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBeth.McLeodPartners.com. Find him on X at HMACBE. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, Martin Straith, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.